it does seem like the trade war is still the biggest overhang, and that's even before you bring in impeachment.
Absolutely. So the markets are very focused on the trade war, and to some extent, obviously, as we see the noise factors in the last few days, the probability of the resolution or some form of a mini deal has been going down. And this is what obviously is reflected in the asset prices, maybe not in the same way, but you've seen the bonds rallying, you've seen obviously equities selling off, and this is clearly going to weigh on the markets in the coming days at least.
Of course, it's risk after risk after risk, however you look at it, whether it's alone, consolidated. I mean, the question really is, how low can yields go, or are they going to end up negative yields?
So stepping back, fundamentally, there's one issue that obviously we're missing here, which is we live in a world where there is a very profound demand for income. And as we have gone through this negative yielding bonds with now close to 27% of the global bonds, that availability of good quality fixed income in the world is shrinking. And that's what is weighing on the yields alongside the slowing growth and lack of inflation now. So coming back to your question, how long can the yield go? If we look at the U.S. Treasury, I think we are trading in a range, and we're bouncing off that lower end of the range at 150. But if you take a medium horizon, 6 to 12 month view and a slowing economy, that range is going to drift lower, which means the yield have a possibility of drifting lower, maybe not immediately, but in a medium horizon, you can see yields moving lower from here.
And Neeraj, I guess you could say that maybe September was an anomaly then when we saw yields ticking higher. And now I'm showing a chart out here on the break-evens that we see in the U.S., and that has basically fallen out of bed as well and breaking below that 2%. We're hovering around that 1.2, 1.3% mark here on some of these break-evens. The market continues to kind of not put their faith on the Fed in terms of stoking any kind of inflation here. So if you take a look at 2019 lows that we saw for Treasuries, 143, 146 or so, do you think we can actually break that? Is it inevitable that we could break below?
I think it's possible, and to some extent it'll go back to the geopolitical risk, the trade tensions, and how much of that weigh into the real hard data. So one of the things we have seen so far is that the sentiment is weak. The capex is obviously somewhat missing. The manufacturing part of the economy is soft in U.S. as well as globally, but the consumer has been resilient. Now, as the sentiment weighs further and you see more of this noise, the consumer can start, or the consumption can start weakening, which actually can take it lower. Now, the Fed is on the path of further easing, potentially, in my view. We'll see more of that. They have taken a page from the mid-cycle correction or mid-cycle cutting of rates from Alan Greenspan back in 1990s, but back then there were some fundamental differences in the economy in terms of the structure of economy, in terms of the aggregate demand from a demographics perspective, and the geopolitical tension. So we are at this point from that range perspective, in my view, the lower end of the range. But given the softening and potential weakening of the economy in medium horizon, you can break through the previous lows.